Welcome back to the Deep Dive. Today we're plunging into a concept that, well, I know many of you are deeply curious about. Building generational wealth. It's this really powerful idea, isn't it? Almost aspirational. Creating a financial legacy that, extends far beyond our own lifetime. But let's be honest for a second. Simply putting your money into investments and just hoping it grows for decades, that's far from a guaranteed path. It can feel a bit like a shot in the dark, actually. So our mission today, and we're looking at a really interesting piece called Evergreen Investments, Building Generational Wealth with Enduring Stocks. Our mission is to uncover the kinds of investments that, well, dramatically increase the likelihood of actually building that kind of lasting wealth. We're not just talking about good companies here, we're hunting for companies with truly significant, enduring competitive advantages. And the big question for you, listening in, is this. What makes certain companies so uniquely positioned to create that long-lasting value, even across economic cycles? And what can we genuinely learn from their strategies? We're going to dive into 3 specific companies today: Amazon, Costco, and Berkshire Hathaway, and unpack some maybe surprising reasons why they're considered evergreen. So let's unpack this foundational idea right at the top. Our source material makes it pretty clear. If you're thinking long-term success, especially generational success, investing in companies with strong competitive moats is, well, absolutely crucial. We're not just looking for a company that's doing well today, are we?
No, not at all. It's about being built to stand the test of time. And that key insight, that significant competitive advantage, it isn't just some fancy term. It really is the bedrock. It means a company has built something so robust, so difficult for competitors to replicate or even penetrate, that it essentially ensures its enduring profitability.
Yeah.
And its market position.
That's more than just performing well this quarter.
Exactly. These companies are strategically set up to continue excelling, far into the future.
Yeah.
That's how they create that long-lasting value we're discussing. It's about more than just market share. It's really about structural resilience.
Okay, structural resilience. Speaking of companies built for enduring value, let's kick things off with Amazon, AMZN. Now, you might think of Amazon primarily as, the e-commerce giant, maybe not the high-flying AI stock that grabs all the headlines right now, but its foundational dominance. And something even more surprising is what makes it so intriguing for generational wealth. I mean, yes, there's its e-commerce supremacy, absolutely. Amazon commands about, 38% of the U.S. e-commerce market?
Sorry, easily outpacing Walmart.
Absolutely dwarfing Walmart, which sits at just over 6%. And let's not forget the power of its Prime membership. That's huge.
Oh, definitely.
We're talking about 180 million U.S. Prime members. They aren't just getting free shipping, are they? It's a whole ecosystem.
Music, video streaming.
Exactly. Services like music and video streaming. That's a serious customer lock-in.
Very sticky.
But I have to admit, when I first saw the numbers for Amazon Web Services, AWS, well, my jaw dropped. We often think of Amazon as the everything store, right? But the real genius here, and maybe the surprising insight for generational wealth, is how it turned its internal operational costs into one of the world's most profitable independent tech businesses. It's kind of amazing.
It really is.
AWS brought in an astonishing $11.5 billion in operating income for Amazon.
Just in the first quarter.
In just Q1. That's nearly double what the company's entire U.S. e-commerce platform earned.
Incredible numbers.
It just fundamentally changed how I viewed Amazon as a company. And then there's the advertising juggernaut.
Right, another layer.
Ad sales hit nearly $14 billion in Q1. That's up a solid 18%. And their position is quite unique, isn't it?
Because it's tied to their platform.
Exactly. Their ad revenue largely comes from sellers placing ads directly on their e-commerce platform or through their video streaming service. The source calls this the icing on the cake for its already lucrative services. So all this adds up. A $2.3 trillion market cap, gross margin nearly 50%. No dividend, though.
Absolutely. And what's really compelling here is how Amazon isn't just diversified, it's diversified in a deeply synergistic way. It all connects. Its e-commerce dominance. That feeds its advertising business with invaluable buyer intent data, which makes those ads incredibly effective and sticky.
Right.
And AWS isn't just some separate division off on its own. It's the very engine that powers, much of the modern internet.
And crucially, Amazon's own operations.
Exactly. It's a prime example of turning a cost center into a massive profit center. One that now outstrips its core retail business by a significant margin.
Wow.
So this multi-layered moat where each part strengthens the others, It makes it incredibly difficult for any single competitor to really challenge its position.
You mentioned vulnerabilities earlier.
Yeah, I mean, look, regulation or intense competition from other cloud providers like Microsoft or Google, those could always be factors, of course. But this internal self-reinforcing model creates a really unique kind of durability.
Okay, so Amazon shows us the power of that tech-driven, multi-layered moat, built on scale and innovation. But what if your competitive advantage isn't about being cutting-edge tech? What if it's about something far more fundamental? Sheer, unwavering customer loyalty.
Loyalty.
Cultivated through a very different approach. That brings us to Costco Wholesale. Cost. This is a company that just consistently delivers value, and its customers respond with, well, incredible devotion. The numbers really do speak for themselves here. Costco boasts 140.6 million cardholders.
Huge number.
That's an increase of nearly 7% year over year. And its membership renewal rate, get this,
It's famously high.
an almost unbelievable 93%. 93%. I often hear people rave about Costco, you know? But seeing these numbers, especially that renewal rate, it makes me genuinely curious. Like, what's the secret psychological hook they have on their customers?
It really does feel almost cult-like, doesn't it, that loyalty?
What's also truly fascinating is Costco's economic resilience. Even as, JP Morgan lowered recession odds recently down to 40%, Costco seems largely insulated from consumer sentiment swings.
Well, look at their customer base.
Right. More than one-third of its customers have household incomes above $125,000.
Which suggests a built-in buffer during economic downturns. They're less squeezed.
And we saw this in action, didn't we?
We did.
When consumer sentiment was actually pretty low earlier this year, Costco's first quarter sales still increased 8% to $62 billion. Still growing. Its market cap is around $436 billion, and it offers a small dividend yield, 0.49%.
It truly is almost cult-like loyalty, and I think it speaks to their unique treasure hunt experience. You never know what you'll find.
Right, the treasure hunt.
And think about it. Many retailers struggle with razor-thin margins, right?
Yeah, notoriously thin.
But Costco found this really counterintuitive way to turn that on its head by charging customers just to shop there.
Yeah, the membership fee.
The compelling aspect here is how that membership model acts as such a unique differentiator. It creates an upfront commitment from the customer that ensures recurring revenue and a very, very sticky relationship.
So they're invested from the start.
Exactly. And simultaneously, it drives these incredibly high sales volumes, which gives them immense purchasing power with suppliers.
Lower prices.
Lower prices, exactly.
Right.
So that unexpected discovery of quality products at unbeatable prices, combined with the perception of incredible value, that's a powerful psychological lever.
Yeah.
So while traditional retail faces all these online pressures, Costco's model encourages a totally different kind of shopping trip, one focused on value and, well, discovery.
Makes its moat incredibly robust.
Very robust.
Okay, so Costco proves that even a seemingly simple model can build an impenetrable moat through customer psychology and value. Fascinating. Now, imagine a company that combines that kind of enduring quality with just unparalleled financial discipline and a diversified portfolio spanning dozens of industries.
They'll say Berkshire Hathaway.
That's Berkshire Hathaway, BRK.A. or BRK.B. Though it faces a unique generational challenge of its own right now. Yeah, for anyone following the financial world, you definitely know the big news. Legendary investor Warren Buffett is stepping away as CEO at the end of 2025. He'll be 94 years old.
An absolute icon.
An icon. And this naturally raises questions for investors, right? About the future of a company so intimately tied to its leader. But there's a lot working in Berkshire's favor that gives it remarkable continuity, or should, anyway. For starters, it's an incredibly well-diversified conglomerate. We're talking more than 60 businesses.
Across many sectors.
Exactly. And here's a critical point on continuity. These individual companies, they'll just continue to function under their current proven leadership.
Right, independently.
Entirely independent of who holds the CEO title at Berkshire itself. And beyond its operating businesses, Berkshire also benefits from a truly massive investment portfolio.
Huge.
More than 30 stocks, investments totaling around $280 billion. And the source makes it clear this portfolio will remain in good hands after Buffett steps down.
Managed by people who learned from him.
Right. Managed by longtime Berkshire leadership who have worked under him since around 2010. They know the philosophy. And finally, let's talk cash. a substantial war chest.
A very substantial one.
Berkshire Hathaway is sitting on an impressive $348 billion in cash and cash equivalents. $348 billion.
That's a lot of firepower.
It gives the upcoming CEO, longtime executive Greg Abel, plenty of options, as the source puts it. Options for continued growth, strategic investments. The company has a market cap of $1.0 trillion, gross margin 23.58%, and like Amazon, no dividend here either.
This definitely raises an important question for many people. Is it truly possible for anyone to fully replicate the intangible Buffett premium?
That's the billion or maybe trillion-dollar question, isn't it?
That unique blend of capital allocation genius and cultural influence that has defined Berkshire for decades. I mean, Buffett is irreplaceable, right?
You'd think so.
But Berkshire Hathaway's strength really lies in its structure. That diversified structure and its immense strategic cash position. The fact that the operating businesses function independently with strong leadership already in place. And the investment portfolio is managed by seasoned executives who learn directly from Buffett himself. It means the core value drivers are robust. They're not solely dependent on one person.
That makes sense. The machine keeps running.
Precisely. And those substantial cash reserves offer an incredible safety net, yes, but also strategic flexibility for future growth. It ensures continuity and opportunity. It's a company fundamentally built to endure, even through, a monumental leadership transition like this one.
So, as we wrap up this deep dive then, what are the common threads? What have we truly seen across Amazon, Costco, and Berkshire Hathaway?
Well, it seems to come down to their unique, often multi-layered competitive advantages.
Right, those moats.
Their remarkable adaptability to market shifts, too.
And their inherent resilience, yeah. Even facing economic headwinds or, like with Berkshire, big leadership changes.
Those seem to be the crucial ingredients for building that long-term value, the kind that can genuinely become generational wealth. And understanding these qualities, it isn't just about these three specific companies, is it?
No, definitely not.
It's about empowering you, the listener, to become more well-informed. Not just about specific investments, but about identifying similar enduring traits in other potential companies you might look at for your own portfolio.
Learning to spot those competitive moats.
Exactly. Even where they might not be immediately obvious.
Exactly. So based on everything we've unpacked for you today, if the goal is truly generational wealth, and if we look beyond just these three examples we've discussed, what other characteristics might define the next wave of evergreen companies? Think about that. What traits would allow them to withstand economic shifts and technological changes, not just for years, but for decades? What stands out to you as the ultimate, most indispensable trait of an enduring business? Something to ponder.